Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week, and all the links are in the show notes below. Topic number one, from good returns on the 29th of July, flatter prices in a well-balanced market. Topic number two, from RNZ on the 29th of July, New Zealanders are urged to break up with property. What? Topic number three, New Zealand Advisor, 29th of July, New Zealand property market. Sales volumes rise, but buyers still hold the cards. Topic number four, from realestate.co.nz on the 28th of July, home run. Prices of homes in New Zealand outpace apartments by more than double. Topic number five, from Stuff on the 30th of July, mortgage switching has hit a new record. This is how to do it. So first up for this week in review, from good returns on the 29th of July, flatter prices in a well-balanced market. Westpac has revised its 2024 house price growth forecast from 6.2% to 4% following sluggish price increases of just 1% in the first half of this year. Despite this downward adjustment, the bank still expects a 6% increase over 2025, according to its latest housing update. Chief Economist Kelly Eckold noted that while housing demand has strengthened this year, supply has increased at a similar pace. House sales have increased 17% year on year, but price growth remains subdued at just 1% over the first half of this year. Eckold explained that supply has become more responsive than usual. A build-up of listings during a quiet period since 2022 is now reaching the market. In other words, people who've been waiting for the market to improve have started listing their properties for sale. New construction, particularly townhouses and apartments, has also remained relatively strong due to a pipeline of unfinished projects now coming to the market. Planning rule changes have played a smaller but contributing role. Investor activity has also been a key driver, spurred by more favourable tax policies and lower interest rates. Investor housing credit rose 5.5% over the past year, contributing significantly to total housing credit growth of 4.7% so far in 2025. Westpac's investor value model suggests house prices currently sit below fair value from an investor standpoint. This means that investors are seeing more opportunities at bargain prices. The bank expects that an improving labour market and continued low mortgage rates, with interest rates under 5%, will support further sales and gradually lift prices. Price growth is expected to stay modest during winter, which is normal, with just 0.75% forecast for the September quarter, but increasing to 1.75% in the December quarter as the market enters its peak season. Kiwibank highlighted a growing regional divide, with the southern housing market performing more resiliently than the north. Since early 2023, national house prices have climbed just 1.8% and only 0.5% since the RBNZ began cutting rates in August. Mobile mortgage manager Shane Horton said that the national market remains flat, struggling to regain momentum. Southern regions like Southland, Otago and Canterbury experienced smaller price corrections during the 2022 to 23 downturn and have now recovered more strongly. Despite falling interest rates, several factors are weighing on recovery: weak job security, high housing stock, low investor activity and declining net migration. Horton noted that investor inquiries are picking up, though this has yet to result in higher transaction volumes. He believes that once interest rates fall further and employment conditions stabilise, investor activity could reignite, though this may increase competition for first-home buyers. Currently, first-home buyers and movers have been keeping transaction volumes steady amid the slowdown. Horton sees investor re-engagement as crucial for market recovery. Policy shifts like reinstated interest deductibility, a shorter bright line test and relaxed lending restrictions have improved sentiment, but more rate cuts are likely needed to draw investors back in. My thoughts are that property investors should not be competing on price with home buyers. Home buyers buy based on affordability and emotion. Property investors should be buying based on the numbers like rental returns, equity in the deal, and potential to increase the equity and market rent just to name a few. It does my head in when property investors are targeted as being the reason for house price increases, when in reality, the majority of buyers in the market at any given time is usually a combination of first home buyers and movers. Movers are the people who are either upgrading or downgrading their homes. Horton stressed that beyond demand, housing supply remains the biggest factor affecting house prices and affordability. While stock levels appear high now, any upswing in migration or demand could expose the country's ongoing shortage of affordable homes. Building consents are still falling in about half the regions, hindered by high costs, weak pricing, and infrastructure challenges. So, as mentioned earlier, housing supply could easily reduce rapidly as soon as more buyers enter the market, which in turn will likely increase prices due to increased demand with diminishing supply. Watch this space. Topic number 2 from RNZ on the 29th of July, New Zealanders are urged to break up with property. Some financial experts argue that New Zealand could benefit significantly if more capital were redirected away from property and toward more productive investments. Jeremy Williamson of Craig's Investment Partners believes that the country's long-standing focus on property is shifting. While property remains a familiar and tangible asset for many, he notes that investing in housing does little to contribute to national productivity. This is a long-standing argument, which I completely disagree with, but I'll come to that later. He emphasised that cycling wealth through buying and selling houses doesn't necessarily improve outcomes for future generations. Williamson pointed out that over the past 30 years, $100 invested in New Zealand property would have grown to nearly $600, while the same amount, $100 invested in local shares, could be worth about $1,100. He acknowledged the appeal of leveraging property, but argued that even reallocating just 10% of that investment into more productive assets could benefit the wider economy and reduce inequality. He also suggested that updated tax incentives could support this transition. Infometrics chief forecaster Gareth Kiernan echoed this sentiment, noting that housing investment returns over the last decade to March 2025 averaged 9.5% annually, and my assumption is that that includes rent increases. And this is close to the 9.34% return of aggressive managed funds or KiwiSaver funds. However, with rising rates and insurance costs, property is becoming more expensive to maintain. And that's true, which is why it's also important to look at the cash flow on an investment property at the point of purchase and to stress test your affordability at higher interest rates than what we currently have, which are well below the long-term average. Kiernan added that KiwiSaver has made more New Zealanders comfortable with financial markets and that recent price drops have reminded investors that housing isn't a guaranteed path to wealth. Rupert Carlian of Cora KiwiSaver agreed, suggesting that demographic shifts like declining population growth combined with economic pressures like inflation and falling real wages may dampen the outlook for property over the next decade. Carlian also highlighted Bitcoin's exceptional performance over the past 10 years, returning 45,000%. However, he warned that such growth is unlikely to continue and advised investors to remain diversified as all asset classes move in cycles. My thoughts on this overall is firstly that none of these people have a vested interest in talking up property investment, but they all have a vested interest in talking up KiwiSaver and managed funds or share market investment. To be fair, there's no guarantees with any type of investment. Even KiwiSaver funds took a hit after Trump announced his tariff war. The difference is that shares can be more volatile, increasing and decreasing in much shorter timeframes, sometimes within days or weeks, whereas property tends to be much more stable with slower downturns and recoveries, taking months or years rather than days or weeks. Now, bearing in mind that I am a financial advisor who gives advice for KiwiSaver, managed funds and property investment, but without the conflict of interest since we don't sell property, my thoughts are this. Although all of the people mentioned in this article seem to acknowledge the benefit of leverage when it comes to investing in property, they haven't really taken that into account when they've done the comparisons. For example, Williamson from Craig's Investment Partners a company, by the way, that I've got a lot of respect for, talks about $100 invested in property for over 30 years would have increased to $600, whereas $100 invested in shares would have increased to about $1,100, which might be a fair comparison if you were talking about buying a property with cash instead of leveraging by just putting in a deposit and borrowing the rest from a bank. In other words, let's multiply that all out to potentially more realistic figures to do a true comparison. Instead of $100 invested, let's compare $100,000 invested. In shares, using Williamson's assumptions for increased values, that would have increased to approximately 1.1 million instead of $1,100. For property, if you paid cash for a $100,000 property 30 years ago, that could now be worth $600,000. But if you put $100,000 down as a 30% deposit 30 years ago, and assuming you could get bank lending for the rest of it, so the 70%, you could have purchased a property for approximately $333,000. Then 30 years later, that property could have been worth approximately $1.998 million, plus rent increases over the 30 years, which could have helped you to pay the mortgage off. So by my calculations, even if you hadn't paid the mortgage off, you could have increased your equity by approximately 1.765 million compared to 100,000 in shares, which could have increased your equity by approximately $1 million. And that, my friend, is the power of leverage. That gives property the competitive advantage over time that the share market doesn't give. Not to mention the passive income that could be generated by the increase in market rent over time. Let me know what you think in the comments. Topic number 3 from New Zealand Advisor on the 29th of July. New Zealand property market, sales volumes rise, but buyers still hold the cards. New Zealand's housing market continues its path to recovery in 2025, showing signs of stability and moderate growth, according to Cotality New Zealand's chief property economist, Calvin Davidson. Sales activity and property values are improving, supported by easing inflation and falling interest rates. However, high listing volumes and slow rent growth mean buyers still hold significant negotiating power. This is great news for anyone who's looking to purchase a home or an investment. We are still in a buyer's market. The broader economic outlook remains fragile, with global trade uncertainty, particularly due to renewed US tariffs, posing potential risks. House sales have risen from their 2023 trough, with over 83,000 transactions recorded in the past 12 months. That's up from fewer than 63,000. Although volumes have been growing steadily, they remain slightly below pre-pandemic norms. April marked the 4th consecutive month of price increases, with a modest 0.3% gain. Hamilton and Christchurch led amongst the major cities, suggesting that the downturn has ended, but growth remains subdued. While new listings are tracking seasonally, the overall supply of homes for sale is still high. This surplus continues to give buyers the upper hand in price negotiations. First home buyers accounted for nearly 27% of purchases in April, maintaining their strong market presence. Meanwhile, lower interest rates are encouraging a return of mortgaged investors, who made up 24% of recent sales. Rental prices have barely moved, rising just 0.6% in the year to March, and this benefits tenants but makes the environment a bit tougher for landlords. However, I think it's important to point out that as house prices have fallen, while rents have still shown small increases, this actually means that rental returns are the highest that we've seen in a long time for anyone looking to purchase an investment property in the current market. With interest rates falling, more borrowers are switching from floating or short-term fixed rates to longer-term options. Overall, lending activity is climbing as market confidence improves. While some economic indicators are turning positive, Davidson warned that uncertainty remains, especially around tariffs. He expects the Reserve Bank's rate-cutting cycle to continue. Cotality projects a rise in annual property sales from 82,000 in 2024 to 92,000 in 2025. A nationwide price increase of around 5% is also expected, though regional differences will remain. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor. And all of our free events are available live and online. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book in a no obligation phone call or meeting with my husband, Paul Roberts, via the website. And that's propertyapprentice.co.nz. Fourth topic for this week in review from realestate.co.nz on the 28th of July. Home run. Prices of homes in New Zealand outpace apartments by more than double. Over the past decade, the value of New Zealand homes has grown more than twice as much as that of apartments, according to new data from realestate.co.nz. Between June 2015 and June 2025, the national average asking price for a home rose by $296,096. That's an increase of 56.8% from $521,183 to $817,279. In contrast, apartment prices grew by only 25.1%, rising from $524,926 to $656,719. And that's a gain of $131,793. Realestate.co.nz spokesperson Vanessa Williams noted that while both property types performed similarly during the first half of the decade, homes have significantly outpaced apartments in the last 5 years. This shift highlights the increasing value of land, which has driven much of the difference. Apartments continue to appeal to many buyers, particularly as more affordable entry points. However, the long-term data indicates that homes may offer stronger capital gains. A survey conducted on June 10, 2025 by Ideally for realestate.co.nz revealed an interesting perception gap. 55% of respondents still considered apartments a better or comparable investment to homes despite the data. When asked which type of property they would buy, 41% were open to either. But when price was removed as a factor, preference swung sharply. 85% said they'd choose a home, with only 15% opting for an apartment. This suggests that New Zealanders continue to associate homes with greater space, land ownership, and long-term lifestyle benefits. Williams noted that unless demand for apartments rise or supply dynamics shift, the gap in value between homes and apartments is likely to widen further. Homes not only offer more land value, but also appeal to a broader buyer base, including families and long-term investors. My thoughts on this are that capital growth in apartments has proven to be patchier than in houses over the long term, but the cash flow on them can also be stronger as an investment, although obviously you need to account for body corp fees and that sort of stuff when you're crunching your numbers. Just as with houses, not all apartments make for good investments. However, at the moment, there are certainly plenty of pretty attractive opportunities available for both home buyers and investors in the apartment markets. Topic number 5 from Stuff on the 30th of July. Mortgage switching has hit a new record. This is how to do it. New figures from the Reserve Bank reveal a surge in borrowers changing mortgage providers. In June, around 30% of new mortgage commitments totaling $2.475 billion came from people switching banks, representing 3,553 loans. According to Auckland University of Technology finance professor Aaron Gilbert, easier access to mortgage brokers is making it simpler for home buyers or homeowners to compare offers. With rising living costs and mortgages being the biggest expense for many, it's no surprise that borrowers are chasing better deals. He noted that even those who don't switch may still benefit as banks adjust their terms to remain competitive. Squirrel Mortgages recommends taking advantage of cashback deals when refinancing. These incentives typically range from 0.6% to 1% of the loan value. Squirrel also advised using cashback amounts to pay down the mortgage, potentially saving about $53,000 in interest on a $600,000 loan and reducing the term by roughly 2 years. But borrowers should be aware of clawback conditions. If they leave the bank within 3 to 4 years, they may have to repay some or all of the cash back. Refinancing before a fixed rate term ends can also incur break fees, especially if market rates have fallen. Squirrel explained that this penalty is calculated based on the drop in interest rates, the remaining loan balance, and the time left on the fixed term. ANZ economists in their July property focus predicted up to 3 cuts to the official cash rate, which could push mortgage rates even lower. They suggested that borrowers might benefit from waiting a bit longer before locking in long-term rates. Fixing for 6 months was seen as a reasonable option, cheaper than floating and likely to line up with expected rate declines. For those looking to fix now, a 2-year term might be a balanced choice, while locking in for 3 years or more might not offer much additional value. My advice? Talk to a mortgage advisor about your options, as they'll give you tailored individual financial advice specific to your situation and the lender that you're working with. Talking about switching banks to get a better mortgage deal? You're not alone. Navigating any property decisions on your own can be tricky, and that's where we come in. Join us at one of our free events called How to Succeed with Property Investing. These events are all available online, so you can gain valuable insights and strategies tailored to today's market conditions, regardless of where you live. Whether you're an experienced investor or just getting started, this free session will equip you with the key tools and insights to make confident, informed decisions. Don't miss out. Register today and take the next step towards achieving your financial success. In our free events, I'll also tell you more about how we can help you as a client to achieve your investing goals. So if you're interested in finding out more about how we can help you, visit propertyapprentice.co.nz today and register for one of our free events. If you've already been to one and you'd like to know more about how we can help you on your journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.